Welcome to the Property Wealth Podcast, where we dive into the world of real estate investing and explore practical ways to build long-term wealth. I'm your host, Sarah Mitchell.
And I'm Mike Reynolds. It's great to be here, Sarah. Today we're diving into something really interesting.
Right? We're going to talk about forced appreciation strategies, but not just the usual cosmetic fixes that everyone talks about.
Exactly. It's about finding those deeper, more impactful ways to increase property value without just slapping on a fresh coat of paint.
Yeah, we'll cover things like strategic renovations, zoning changes, and even neighborhood revitalization efforts. It's all about maximizing your investment, right?
Absolutely. And for those of you who might feel a bit overwhelmed by all of this, don't worry. We'll break it down into manageable steps that anyone can take.
And, even if you're just starting out or you've been in the game for a while, there's something here for everyone.
For sure. We want to provide you with actionable insights that you can apply right away.
So let's get into it. Where should we start, Mike? What's the first thing investors should consider when looking to force appreciation?
Sarah, one of the reasons this topic of forced appreciation strategies is so important right now, especially for those of us over 40, is that many people are really starting to think about retirement timelines.
Absolutely. And with the current economic climate, inflation is a huge concern. It's like, how do you ensure your investments keep up with rising costs?
Exactly. I was speaking to an investor recently, let's call him John. He's in his early 50s, and he's been feeling the pinch of inflation. He's got a decent portfolio, but he realized that if he doesn't actively grow the value of his properties, he might struggle to maintain his lifestyle in retirement.
That's a real concern. So what did John end up doing?
Well, he started looking at forced appreciation strategies beyond just cosmetic updates, Instead of just slapping on a fresh coat of paint or upgrading the kitchen, he focused on things like zoning changes, adding additional units, or even converting spaces into short-term rentals.
Right, it's about maximizing the potential of the property, not just making it look nice.
Exactly. John found that by adding an accessory dwelling unit to one of his properties, he could not only increase its value, but also create a steady stream of income. That income, in turn, helps offset his living expenses as he approaches retirement.
That's smart. It's like he's thinking ahead, right?
Yes, and that's the mindset we need to adopt. When you're over 40, you want to build wealth that not only supports you, but can also be passed on to your family. Wealth transfer is a big thing, especially when you think about future generations.
Definitely. I've seen so many families benefit from inherited properties that were well maintained or had appreciated significantly over time.
And it's not just about the financial aspect. There's an emotional side to it too. Knowing you're building something for your family, that gives you a sense of security, doesn't it?
For sure. I think a lot of people underestimate that emotional connection to their investments. It's like, they're not just properties, they're legacies.
Right, and as we're seeing market shifts, it's crucial for investors to adapt. The traditional ways of investing don't always work anymore.
Oh, absolutely. With the market fluctuating, if you're not proactive, you could be leaving money on the table.
Yeah, I was chatting with a couple, let's call them Mark and Lisa. They bought a duplex in an area that was kind of up and coming. They were originally just looking to rent it out, but they realized that the neighborhood was about to see a lot of new development.
So they capitalized on that?
Exactly. Instead of just waiting for the market to appreciate, they worked with local authorities to understand the development plans and got in touch with the right contractors to enhance their property. They ended up creating an outdoor space that attracted higher-end tenants.
That's fantastic. It's like they became part of the community's growth.
And that's what it's all about. By being proactive, they not only increased their property's value significantly, but also built a community around their investment.
Wow, I love that. It's like investing in real estate became a way to invest in their future and the future of their community.
Exactly. And for those of us over 40, we're often in a position where we can leverage our experiences and networks to make those informed decisions.
Yeah, I think about the connections we have, the knowledge we've gained. It's all valuable.
Right, and that's why forced appreciation strategies are so relevant now. With inflation and economic uncertainty, you want to ensure your investments are working as hard for you as you've worked for them.
That's a great point. And it's something that a lot of people, especially those in their 40s and beyond, might not fully understand yet.
Exactly. It's about being smart and strategic, rather than relying solely on market trends.
So what's the takeaway for our listeners?
Well, the key is to think beyond the surface level improvements. Look for ways to add real intrinsic value to your properties. Whether it's through strategic renovations, zoning changes, or maximizing rental income, it all contributes to forced appreciation.
And that's something they can start doing today, right?
Absolutely. It's never too late to start implementing these strategies, and the sooner you begin, the better positioned you'll be for the future.
That makes perfect sense. I can't wait to dive into the core strategies with you.
Let's do it. So, Sarah, when we talk about forced appreciation strategies, it's really about finding ways to increase a property's value without just relying on the market to do its thing, right?
Exactly! And there's so much you can do. One of the most common strategies is, making physical improvements to the property. But we're looking beyond just cosmetic fixes, like a new coat of paint or fresh landscaping.
Right. Those are nice, but if you want to see real value increases, think about structural improvements. For instance, adding a bathroom or finishing a basement can really change the game.
Yes, I've seen cases where simply adding an extra bathroom can increase a property's value by, 20% or more. It's a great return on investment.
Totally. And then you have things like upgrading the kitchen. You can sometimes recoup 70% to 80% of the remodeling costs. And it doesn't always have to be a full renovation. Sometimes just upgrading the appliances or countertops can make a big difference.
That's a great point. So it's about understanding what improvements yield the best return. What other strategies do you think are important?
Well, another effective method is improving energy efficiency. Adding insulation, upgrading windows, or installing solar panels. These not only attract tenants who want lower utility bills, but also increase the property's value over time.
That's a smart move. Plus, there are often tax incentives for energy-efficient upgrades, which can help offset initial costs.
Exactly. And let's not forget about location. Sometimes simply changing how you use the property can increase its value. For example, converting a single-family home into a multifamily unit can dramatically increase cash flow and overall value.
Oh, that's a big one. If a property can support multiple tenants, you're looking at a significant boost in income, which can translate to a higher valuation.
Right, and that leads us to the importance of understanding the 1% rule. Essentially, you want to aim for a property that can generate 1% of its purchase price and monthly rent.
Yeah, that's a good benchmark. So if you're buying a property for $300,000, you'd want it to rent for at least $3,000 a month.
Exactly. It's a quick way to assess whether a property might be a good investment or not. And then there's the 50% rule. This is a simple rule of thumb that suggests you should expect around 50% of your gross rental income to go toward expenses.
That's crucial for budgeting. So if you're expecting to earn $3,000 a month, you should budget $1, $500 for expenses.
Right. And then you can calculate your net operating income, or NOI, which is basically your gross income, minus those expenses. It's a key number to know when evaluating a deal.
And that ties into understanding cap rates, right?
Yep. The capitalization rate gives you an idea of the potential return on investment. You calculate it by dividing the NOI by the property's purchase price.
So if your NOI is $30,000 and you bought the property for $300,000, your cap rate would be 10%.
That's right. A higher cap rate generally indicates a better return, but you need to consider other factors too.
Like the condition of the property and the market conditions in that area?
Exactly. And it's also important to evaluate your financing options.
Oh, yes. So many people overlook this. Are you talking about things like conventional loans versus hard money loans?
Exactly. A conventional loan is usually better for long-term investments because of the lower interest rates, but hard money loans can be useful for quick fixes or when you need to move fast on a deal.
Right. Hard money lenders usually charge higher interest rates but can close deals quickly. So it's all about knowing when to use which option.
And let's not forget about different property types. Single-family homes, multifamily units, commercial properties, each has its own set of advantages and challenges.
Yeah, and understanding your market is so critical. For instance, in some areas, multifamily units are in high demand, while single-family homes are more desirable in others.
Absolutely. Knowing your target market can help you decide what type of property to focus on and which improvements to make.
And then there's the importance of a good deal evaluation checklist. What do you usually include in yours?
Well, I start with the basics: property condition, neighborhood trends, and comparable sales in the area. I also look at potential rental income, expenses, and the overall financial metrics we've discussed.
That's smart. It's like having a roadmap to guide your decisions.
Exactly. And don't forget to factor in potential risks. Market fluctuations, unexpected repairs, those can throw a wrench in your plans.
So true. It's essential to have a buffer for those unexpected costs.
Yeah, a good rule of thumb is to set aside about 10% of your gross rental income for maintenance and repairs.
That makes sense. And all of this really helps in building a solid investment strategy.
It does. But as we wrap up this part of our conversation, it's a good time to transition into common pitfalls investors face.
Yes, I think that's a critical topic. Avoiding those mistakes can save a lot of time and money.
So, one of the big pitfalls I see a lot of investors fall into is over-leveraging. It sounds a bit technical, but it really just means borrowing too much money relative to your income or the property's value, which can be risky.
Yeah, I can see how that would be a slippery slope. What kind of problems does that create for investors?
Well, think about it. If you stretch yourself too thin financially, just one hiccup, like a tenant not paying rent or a sudden repair, can really throw your whole plan off. I had a client once who bought a property using 90% financing, thinking the market would keep climbing. When it didn't, they were left with a mortgage that was way too high for the rental income they were getting.
Ouch, that sounds painful. Did they manage to recover from that?
Eventually, yeah, but it took a lot of work and some tough decisions. They had to sell the property at a loss, which is never easy, but it taught them a valuable lesson about balancing leverage with cash flow.
Right, cash flow is everything. But I imagine it's easy to get caught up in the excitement of a new investment and ignore that aspect.
Exactly. Another common mistake is ignoring cash flow entirely. I mean, sure, the property might look great on paper, but if the expenses exceed the income, that's a recipe for disaster.
Can you give an example of that?
Sure. A friend of mine bought a duplex in what they thought was an up-and-coming area. The projections showed a good rental yield, but they didn't account for things like property management fees, maintenance, or even higher property taxes. So when they finally got tenants in, the cash flow was negative almost from day one.
Wow, that must have been frustrating.
It was. They ended up having to dip into their savings to cover the shortfall each month. It's a tough lesson to learn, and it could have been avoided if they'd done a little more due diligence on their cash flow projections.
So what's the takeaway here? How can investors avoid this kind of pitfall?
Well, I always say, do your homework. Look at all potential costs, not just the mortgage. And consider working with a financial advisor or a property manager, someone who can help you crunch those numbers realistically.
Great advice. What about bad tenants? That can be a huge issue too, right?
Definitely. Bad tenants can really wreak havoc on your investment. I've seen folks who were so eager to fill a vacancy that they skipped the screening process just to get someone in there. Then they faced issues with late rent, property damage, even legal evictions.
That sounds like a nightmare.
It is. I had another client who rented to a tenant without checking their rental history or credit score. Turns out, the tenant had a history of evictions. They didn't pay for 2 months, and by the time my client got them out, the property needed a lot of repairs.
Wow, that's a tough lesson. So, what can investors do to find good tenants?
It really comes down to screening. Thoroughly. Check references, credit reports, and rental history. And don't be afraid to wait for the right tenant instead of rushing into a lease. It can save you a lot of headaches in the long run.
Absolutely. And I suppose that ties into another common mistake, timing the market.
Yeah, that's a tricky one. Investors often think they can time their purchases, buying at the bottom and selling at the top. But the reality is, nobody can predict the market perfectly.
So what happens when someone tries to time the market?
I had a student who waited for what they thought was the perfect moment to buy, but the market kept climbing. They held off for months, waiting for a dip that never came. Eventually, they had to jump in at a much higher price, which cut into their potential profits.
That must have been discouraging. What's the best approach then?
Instead of trying to time it, focus on the fundamentals of the property and the area. Look for properties that cash flow well and have potential for appreciation, regardless of short-term market fluctuations.
That makes sense. And what about hidden costs? I imagine there are a lot of things investors overlook before making a purchase.
Oh, for sure. Hidden costs can really add up. Things like closing costs, maintenance reserves, insurance, and even HOA fees. They can surprise new investors.
Any real-life examples of that?
I had a client who bought a condo thinking the monthly fees were manageable. But after closing, they discovered the HOA had plans for a special assessment for roof repairs. Suddenly, they were hit with a huge bill they hadn't budgeted for.
Yikes! How can investors avoid those surprises?
It's all about asking the right questions during due diligence. Get a clear understanding of all potential costs associated with the property. And, don't hesitate to dig into the property's financials and the HOA's history, if applicable.
Those are really valuable tips. So if someone finds themselves in a tough spot, what's their next step?
Well, first, take a deep breath. There's often a way to recover. If you're over-leveraged, consider refinancing or restructuring your loans. If you have bad tenants, start the eviction process if necessary, but always follow the legal route. And keep learning from your experiences. Every mistake can be a lesson.
That's encouraging. It sounds like it's really about being proactive rather than reactive, right?
Exactly. The more informed you are, the better decisions you can make. And, of course, building a reliable team of advisors can help you navigate those challenges along the way.
Great insights, Mike. Thanks for sharing these real-life lessons. It's a lot to think about, but I feel like listeners can really take this advice and apply it to their own investing journey.
Absolutely. Just remember, every investor has faced challenges, and it's part of the process. Learning and adapting is key to long-term success.
Well, let's dive into some next steps for our listeners.
All right, so now that we've explored some of those forced appreciation strategies, let's dive into some immediate next steps and tools you can use today.
Yeah, I think that's super important. It can feel overwhelming, but starting small is key, right?
Exactly. So first off, I'd recommend setting a goal for yourself. Maybe it's analyzing one deal a week, just to get into the habit of evaluating properties.
That sounds manageable, and it keeps you in the game. What tools can they use to analyze those deals?
Great question. Apps like Zillow can be really handy for checking property values, rental rates, and recent sales in the area.
And it's pretty user-friendly, right?
Yes, very much so. Then there's the BiggerPockets calculator. That's a fantastic tool for running the numbers. It can help you understand cash flow, ROI, and really break down the investment side of things.
I love that. It sounds like it gives you a clear picture, which is so crucial, especially if you're just starting out.
Definitely. And don't forget about Deal Check. It's another great app for analyzing properties on the go. You can compare different deals and see which one stands out.
Oh, that's nice. So you can really make informed decisions without being tied to a desk.
Right. And then there's Rentometer, which is perfect for checking rental prices in specific neighborhoods. You want to make sure you're competitive with your pricing,
Absolutely. And I think having that data can really empower you, especially when negotiating or making offers.
For sure. Also, if you have access to your local MLS, that's a gold mine. You can get the most accurate and up-to-date information about properties, trends, and market analysis.
Yeah, knowing what's actually happening in your market is crucial.
Exactly. Now let's talk about building some habits. Joining a local real estate meetup can be a game changer. Networking with other investors opens up so many opportunities and insights.
Oh, I love that idea. Meeting like-minded people can really motivate you and provide support.
Right? And sometimes you can find a mentor this way, someone who's been through it all and can share their experiences.
That's so valuable. And it can really help you avoid common pitfalls.
Yes! And speaking of mentors, I think reading is another great step. There are some fantastic books out there. The book on rental property investing by Brandon Turner is a solid start.
I've heard great things about that one.
Yeah, and Real Estate Investing for Dummies is another classic that breaks down the basics in a really digestible way.
Those sound perfect for someone just starting out. Any podcast that you'd recommend?
Absolutely. The Bigger Pockets podcast is a must listen. They cover a wide range of topics and have interviews with successful investors.
That's awesome. It's always inspiring to hear real stories from people who've made it work.
Right? And they share actionable tips too. Another one I like is the Real Estate Guys radio show. They explore different investment strategies and market trends.
Those are great resources. So all of this sounds like it can really help someone get started.
For sure. But remember, it's all about progress, not perfection. Start where you are, even if it's just dedicating a little time each week to learn and analyze.
Right, and the key is to take consistent action over time.
Exactly. And don't hesitate to revisit your strategies as you learn. Real estate is a journey, and you'll keep evolving.
I love that mindset. So, with all these tools and strategies in hand, listeners can feel empowered to take the next steps in their investment journey.
Yeah, and it's important to remember that every small step counts. You're building a foundation for long-term wealth.
With these tools in your pocket, you're ready to move forward. Let's recap what we've covered today.
So, as we wrap up, just to highlight a few key takeaways from what we discussed about forced appreciation strategies, right?
Absolutely, Mike. I think one of the biggest points was understanding that forced appreciation isn't just about, cosmetic improvements. It's about making strategic investments that enhance property value.
Exactly. And we touched on leveraging renovations that are more structural or functional, like improving energy efficiency or increasing usable space, which can have a huge impact.
Right. And then there's the importance of location, too. Sometimes just enhancing the curb appeal can make a world of difference, especially if it's in a growing area.
Yeah, and don't forget about the market dynamics. Knowing when to buy and how to position your property in the market can really maximize that appreciation.
Well said, Mike. It's all about being strategic and informed. And, building wealth through real estate isn't just a dream. It's very much achievable with the right knowledge and approach.
For sure. It takes time, patience, and a bit of courage, but those who stick with it can really see incredible returns over the long haul.
And I want to encourage our listeners to think about their journey. If you found today's episode helpful, please like, subscribe, and share your biggest takeaway or any questions you have in the comments.
And if you know someone over 40 who's interested in investing in property, definitely share this episode with them. It could really make a difference.
Definitely. And just a little teaser for next time, we're diving into a really interesting topic: flip or hold, decision framework.
That's going to be a great discussion, Sarah. I'm looking forward to it.
Me too. Thanks for joining us today, everyone.
Yeah, take care, everyone, and happy investing.